Let's refocus our attention on these equity markets this morning. Joining us with a look at equity strategy, Emily Sanders, President and CEO of Sanders Financial Management. Emily, nice to see you.
Good morning, Jeff.
Thank you for coming in. What advice are you currently giving to clients whose money you're holding as to what they should do in this current period of turbulence that we're seeing, this weakness?
Well, we're advising our clients to stay the course and not panic. This is a necessary inflection point after the markets had run up a good bit in the last few months. And we're still favoring very strongly international equities up to 20% of the client's portfolio. And our typical client are emerging affluent individuals and families with between up to 2 million, 3 million US dollars or 1.5 million pounds.
The pullback then you feel is a temporary correction. It's a taking out of some hot air in the bubble. We continue to go up in international equities.
Yes, we do. And as Abby Joseph Cohen mentioned earlier, the international markets, particularly emerging, have been particularly volatile. But we believe that Europe, Eastern Europe, and the Asian markets are still very attractive.
What about treasuries at this point? I mean, Emily, you're seeing yields moving higher. Is that a place for people's money in addition to equities? What does the allocation look like?
The allocation looks like 60% equities, 40% fixed income, and within that equity range, it would be 20% large and mega cap stocks, 20% small cap stocks, which we still favor, at 20% international stocks, and then of the 40% fixed income, we'd be looking at 10% in cash and the rest in taxable and tax exempt, depending upon the type of client account.
So talk to us about some of that. I mean, the big caps have been under pressure for so long. What's wrong with the big caps? And as far as international stocks, where specifically, what geographies are you betting on?
We really like Europe, Eastern Europe, because of the growth potential there. You know, the high rates of economy growth compared to the more mature European market. And we still like India, despite what happened yesterday, and parts of Asia, China, although we do prefer India to China.
Louisa.
Emily, yeah, good morning. Would you favor U.S. equities, though, over Europe? You just said that you still like Europe, but when you look at the year-to-date gains, those European gains were just erased as of yesterday, where the U.S. is still outperforming European equity markets now. And half a year ago, we were all speculating whether or not this would be the year for U.S. markets to outperform compared to the growth that we had seen in Europe and the restructuring story out of Germany, et cetera, et cetera.
We feel that there is a good probability that both the U.S. and European markets will end the year close to 10%, although as of today, that looks like a stretch. As of 2 weeks ago, it seemed highly probable, and we do feel that this correction was a necessary pause and inflection in the market.
So where specifically in the big caps, Emily?
Well, we like pharmaceuticals, we like banks, and we also well, we like energy stocks now that they've taken a pause. But in particular, we're really looking at things like alternative energy and water as a fresh idea from the big caps due to pressure on oil and energy throughout the world.
How concerned are you by the macro environment? Primarily, I assume you do a lot of bottom-up stock selection to determine whether you've got the right allocation for the client here. But in terms of the macro story at the moment, are you able to resolve to your own satisfaction the difference in growth rates between European economies and the American economy? You look at how the US has performed, and it has defied its critics. Here in Europe, we're still struggling to understand how Germany, or why we're getting excited about Germany performing at 0.4%.
Well, the U.S. has defied its critics, and we continue to be concerned about the U.S. deficit, the ballooning U.S. deficit, the raising of the debt ceiling to $9 trillion recently. Those are fundamental concerns that haven't gone away. We're also concerned about the bulge of baby boomers that will be retiring in the next decade, as well as the elderly cohort that's putting a lot of pressure on the Medicare system, as well as the stealth inflation. But that aside, we are optimistic about the U.S. economy. It is very resilient. The consumer has been the engine that's been pushing the U.S. economy, and in fact, really helping the economies throughout the world of which the U.S. buys their goods. So we really feel like the stage is set for a good year in 2006. 2007 is a little too early to call.
Okay, maybe we'll have you back and we'll get you to call that one as well for us. Emily, nice to see you.
Well, thank you, Jeff.
Thank you very much.
Thank you, Maria.
Emily Sanders, President and CEO of Sanders Financial Management.